Hello and welcome to the Leadership and Insurance Podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Edward Ryall, who is the co-founder of Neptune Mutual. Edward, good morning. Well, it's good, just about good afternoon where I am. Where are you joining us from?
Hi, Alex. Yeah, pleased to join you. I'm calling in from Bordeaux, so southwest of France.
Oh, very nice. I actually I didn't know that. I thought you were going to be Asia bound for some reason. I think some of the team is. I might be making that up, but no, I know Bordeaux very well. I went there for a very lovely holiday. Obviously, too much wine, as you can imagine, but otherwise, why go? Edward, it's really kind of you to join us. I'm excited to have this conversation. But co-founder of Neptune Mutual, I think it'd be really good if you could just start with introducing the Neptune Mutual business and what it is exactly you do.
Sure, yes, I'd be happy to. So I think most of your listeners will be familiar with the fact that blockchain over the last few years has opened up opportunities for investors of one form or another to own digital assets. And where you have assets, then there's risk associated with holding those assets, and Neptune Mutual was designed as a way to mitigate some of those risks. So it is categorized as a DeFi insurance protocol, and so Neptune Mutual provides in its marketplace the opportunity for projects to create cover pools, and in so doing, enables those communities to purchase cover policies that protect the digital assets of those communities. So that's the sort of a little bit of a summary, I suppose, of what Neptune Mutual what Neptune Mutual is, what it does.
Fantastic, thank you so much. And you guys, you raised relatively recently, didn't you? It was a sort of $10 million round, Series A. I always like the founding stories. How did the team know each other? How did you all get together?
Yeah, so I guess we're a true fit with a sort of decentralized culture of of much of the blockchain anyway. We talk about the DeFi, so decentralized finance space, and our team is very much true to that. That's to say, so the originator and the CEO of Neptune Mutual, Binod Navan, is Nepalese. He's based in Nepal and Dubai, and he has a background in blockchain, dating way back to the very beginning of blockchain, but his expertise is in cybersecurity, and he is the person who's been responsible for all the tech development of the company to date. And the other co-founder is Gillian Wu, who's based in Hong Kong. She is, in addition to being co-founder of Neptune Mutual, she runs a crypto venture capital firm that she founded, Mulana Capital, and she previously was CEO of Hobie Asset Management and was responsible for getting all the compliance and licenses for Hobie's digital asset management company in Hong Kong. So so I'm in Europe. We have Gillian in Hong Kong and Binod, who is in Dubai and Nepal.
Brilliant. A decentralized team for a decentralized market. Yeah, I like it. I like it. There is something about that probably feels much more natural than other places, because it's a very much a decentralized marketplace. I'm going to clarify off the bat, Edward. I think I told you when we spoke before that my knowledge of this area is probably some really badly thought out investments in various cryptocurrencies over quite a boozy Christmas, and I haven't looked at it since, because I think that seems to be the best advice I've had from my friends, is that if I did look, it wouldn't be very pretty. I think it's good to sort of start clarifying some of the kind of numbers around this. So how big is the sort of insurance risk in the crypto marketplace?
Well, I suppose the easiest thing is to quantify the assets in the space. That's probably the easiest number. And so some of your listeners may be familiar with DeFi Llama. I mean, there's plenty of data aggregators where you can pick up this information from. DeFi Llama is quite simple and easy to use. And if you go there and have a look at what we call TVL, so that's the total value locked, that gives you some indication as to the assets in the space. And in the decentralized finance, so the DeFi space, you'll find there's around about $49 billion worth of assets And so arguably speaking, all of those assets are at risk from one sort or another.
And that, I mean, I suppose we'll probably get onto this, but I'm sort of defining what the risks are and what are the specific risk exposures that we're covering for.
Well, of course, there's a whole spectrum of different types of risks, and depending on what part of the crypto market you're interested in and involved in, obviously there's different types of risk. So unfortunately, many people will be familiar with some of the risks of the centralized model. So we heard last year about FTX. So FTX is a centralized exchange, and where you're trusting a centralized authority by depositing your crypto or your digital assets with that centralized entity, and you've deposited there, then like any centralized authority, whether it be crypto or indeed a bank, as again we've seen even more recently this year, those assets can be at risk. So SVB, one might have thought that was a safe place to deposit your assets, but it turned out that wasn't the case. So if centralized institutions across the board, TradeFi, CeFi, custody risk is what we call it, is where you've placed your deposit. That is something which you have to be careful of. So in the Neptune Mutual cover marketplace, we do have some CeFi, centralized finance protocols, where you can, as a user, take out a cover policy to protect yourself against the risk of a centralized entity. So we, on our cover marketplace, for example, have a partnership with OKX Exchange. And there, if there is a liquidity problem with OKX, then those users who have cover policies on our marketplace will get paid out in the event that kind of risk occurs. So that's one type of risk in the centralized part of the system. In the decentralized part of the system, we talk more about other types of technical risk, because being decentralized, much of the financial transactions that take place are being managed through smart contracts. So you don't have to trust an individual or a centralized entity for something to happen. You have to trust the code that it works. And so the risk in those types of projects, so DeFi projects, are that the code doesn't work for one reason or another. And so for that type of risk, smart contract risk, you can also buy cover in our marketplace.
Perfect. And I think that clarification is important, because one thing I wanted to move on to is that, if I listen to the noise out in the traditional insurance markets and the markets that and the audience are probably much more aware of, you'd think that they've got this on handle, or at least they're sort of attempting to handle it. What has DeFi insurance got wrong today? And suppose, why is there a need for a Neptune Mutual in this instance?
So a couple of questions there. And I think the first thing I would say is, I don't necessarily think that to date, DeFi insurance has got anything wrong. There's definitely things that can be done differently. There's a huge amount of opportunity for innovation. And I mean, if you have a look at the space at the moment, I think you can see that there's room for improvement, quite simply because the DeFi insurance category is so small. It's I think it's around about $330 million worth of TVL, to total value locked, which when you could put in comparison to the $50 billion or $49 billion worth of assets, you can see it's really very, very small. So way more than 99% of digital assets are totally unsecured, which kind of doesn't make a lot of sense when you immediately think of doing transactions and activity in what most people would consider is a risky place. So I think the important thing is to ask, well, why, and what is it that we can do better in the insurance category? And that's something that we thought very, very hard about, because I think insurers are risk averse. And one thing that is true is that the blockchain space is new, it's young. There's not that much data available because it is so young. The risks associated with blockchain projects are therefore also young, or that's to say, they need a lot of very specific technical expertise to understand them and try and evaluate them. So it is quite understandable, and I would say even normal, that traditional insurers are reticent about jumping into a space with so little data, so little information, and so many risks, because it's not easy to get it right. And I think we've had a great start. Nexus Mutual is the market leader, and they've done a great job. There are a number of others as well who have been paid out when incidents have arisen, and that's obviously very, very important to establish credibility. And a number of insurance protocols have done that and met the protection requirements that they have set out to achieve. But we think there are definitely a number of things that can be done to improve. I mean, we are guided by four principles in that respect. Firstly, and I think most importantly, is security, because as an insurance protocol, that's what our objective is, to protect people from security risks. And therefore, almost by definition, any DeFi insurance protocol is subject to the same and possibly even more, security. We're targeted, if you like, perhaps even more than other protocols. And again, that's where having a CEO who has a background and expertise and a passion, I should add, that he shares with the whole team around security is really important. So security is one. We have then risk, scalability, and UX as the other three. So we try to minimize risk, which is the kind of counterpart to security in some respects. But the whole design of our business model is designed to reduce risk in a whole variety of different ways. And as I've said before, the DeFi category, the DeFi insurance category, is very, very small. Why is that the case? I think there's a whole number of reasons, and hopefully the marketplace concept that we put together for a whole variety of reasons is one that's scalable. It's something that everyone wants to achieve, but it is really just a consequence of how you design the system that you put in place. And then finally, UX. And again, UX is one of those things that everyone knows is important. Everyone wants to be good at it. It's not a secret that it's, a massively important factor in success. But actually getting it right, even though everyone knows it is important, is it's really difficult, really, really difficult. So we do try really hard to get our community giving very regular feedback to us. I mean, that's just one thing that we can do. But those are the four kind of guiding principles to how we can do better as a player in the DeFi insurance space.
I think it's really interesting. We work with a lot of traditional carriers now that are building out innovation functions, and one of the things that they're all looking at is things like net new risks. But you hit the nail on the head there. Is that it's not necessarily that in-house they have the capability, and we're talking about data and skill sets to kind of deliver on some of these solutions. And I know a criticism in the past in the insurance industry has been very good at selling insurance for people that don't need it. And actually trying to offer insurance, particularly in this net new space for emerging risks, is particularly challenging. So that's why this kind of collaborative, the opportunity to collaborate from the insurance industry to looking at alternative new businesses that are offering different solutions is very appealing. But I'm interested that why you obviously got a marketplace solution. We love marketplace solutions on the podcast. For various reasons, but why was sort of a marketplace the right type of solution for this type of risk?
Well, so there's I guess a variety of answers to that question. Probably the foremost answer is scalability. So that's the first answer. So as a marketplace, what's created in the marketplace are cover pools. And those cover pools are created by cover creators. And typically those cover creators are DeFi or CeFi projects themselves. So Neptune Mutual is not a player, so to speak, per se in the insurance space. We've put or DeFi insurance category, if I can put it like that. We have a marketplace. And so we found with partners like OKX, for example, they've created a pool with cover policies, and that means that not only is it scalable, because anyone can contribute liquidity to that cover pool. Anyone in our ecosystem can contribute. So it's not Neptune Mutual that's the constraint to the amount of liquidity in that cover pool. Anyone can provide liquidity. So that's one of the things. But the second thing is that who better to define what risks should be covered and then communicate how they're covered with parametric cover, which is a bit different and requires some education. And who best to do that than the projects themselves? So rather than us struggling to communicate to the entire blockchain community how parametric cover is different from other types of like discretionary cover, which is more typically found in this space, that requires some time and explanation as to what's different, how it works, and so on. And we find that whilst we're willing to help make those explanations, they do come more naturally and more simply and more directly from those who create covers. So for those two reasons, scalability and the fact that the cover creators are tailoring cover policies to their specific community needs, for those two reasons, the marketplace seemed to us a good approach. I mean, it's definitely not the only one, but from our point of view, those are the reasons why we liked it.
Yeah, makes sense. I picked this up with you previously when we spoke, but obviously Mutual has a particular implication in the insurance industry. You're obviously called Neptune Mutual. That lends itself to sort of how does the business generate money? Just so we've got it in really simple terms, how does the revenue come out of the way that you've structured the business?
Yeah, well, I'd say so. The first thing is that the mutual part of the Neptune Mutual name isn't. We're not a mutual in the traditional sense of the word mutual. That's the first thing. But there again, that's okay because nothing we're doing is that traditional anyway. So it's all new. It partly conveys the idea that we have an ecosystem, and that so in our particular case, which is obviously different from the normal traditional business sense, where you might talk about an association or a cooperative or other systems. But in our particular case, our ecosystem is our token holders. So whilst a mutual insurer perhaps would have collective self-insurance, our model isn't quite like that, in the sense that there isn't collective self-insurance where everyone is putting capital into a combined bucket and then suffering equally or in a pro rata fashion if there is a loss. That's not how we work. But nonetheless, what is true to say is that we're not centralized. That's to say, you asked a question about revenue, and for me, having been so long in the traditional business, revenue is very much the first thing you see on an income statement. And usually traditional businesses want to have lots of revenue, relatively few expenses, lots of profit, and then give that back to shareholders, or pay bonuses, or IPO or one thing or another. The decentralized model, of course, is very different. And so we are part of our own ecosystem in the sense that we hold tokens. So we're not really looking to generate revenue, because the revenue is where centralized organizations extract value, in some sense, from the two parties that they're dealing with. And in our case, the value is totally shared. So we're a peer-to-peer system where on the one hand you have users or individuals that are providing capital for underwriting and making a return on that capital. And on the other side, you've got peers or individuals who are purchasing cover and benefiting from the protection of that underwriting capital. And nearly all of the value is shared between those peers, which is what makes decentralized, of course, it's what makes those models so compelling, because being given as there's no centralized organization, there is no need to extract any value. Now there is, so just to be completely transparent, as is often the case, there are protocol fees that are used, but that's really just to make sure that the whole project is sustainable long term, forever and a day. So there's sort of the minimum level of operating costs are covered with protocol fees, but those the protocol fees themselves are, if you like, shared with the token holders of the organization. So yeah, decentralized models are quite different in that respect. And so there are very much similarities between a mutual model, but it's possibly, if people are very familiar with mutual models, it might be misleading if they think that that's exactly how the Neptune mutual model works, because it is a bit different.
No, but I think the ethos carries through, and I can understand where that's an appropriate title, and it's a cool name. So there's you've got that is also important too. I'm always fascinated how long names take to get to put together as well, because it's always kind of part of the kickoff process. I've been talking about name and the strength of name. We talked about brand, and brand seems to be incredibly important to the crypto market. How does insurance play into that, or how does insurance solve an issue of a sort of attack against brand, as it were, in the crypto space?
Well, that's really a great question, and one that isn't asked enough. So thank you for asking it. And I think we can see through, to be honest, a whole variety of different examples why brand is important. And the reason is because with brand comes confidence. So obviously it's a pretty general term. And why is confidence so important? Well, it's particularly important in fractionalized financial systems, as we've unfortunately seen with Silicon Valley Bank. And the reason is because obviously with traditional finance and crypto, I mean, it cuts across categories, but wherever you have fractionalized finance, that's to say you have depositors depositing money, and they're wanting to earn something for depositing that money. The only way a financial institution, so let's say a bank like SVP, has of generating a return for those depositors is to lend the money out. So that's kind of obvious. But then the obvious conclusion of that is, well, if the bank's lending deposits out, and everyone wants their money back all at the same time, then the bank's not going to have enough money to pay the depositors back all at the same time, which is obviously, the in very simplistic terms, the issue around bank runs. Now, given that there's a structural problem with fractionalized finance, if everyone wants their money back all at the same time, you have to ask the question, well, why would everyone want their money back all at the same time if that's what's causing the problem? And the answer to that question is people all want their money back in a scenario where they all lose confidence all at once. So why do they all lose confidence all at once? And we had that question last year when it arose with obviously FTX, so the centralized finance exchange in the crypto markets. And much of the commentary was around, well, obviously the reason that people had no confidence was because there was a lot of, how can I put this, incorrect activity going on, which there was, but the lack of confidence would have been solved if there had been auditing and if there had been, regulatory compliance. And those are fair comments, because both of those things do contribute towards confidence. But they're by no means a magic bullet solution, as we've seen with SVB, because they were regulated and they were audited 14 days before they collapsed by KPMG. And nonetheless, there was a massive loss in confidence that led to a bank run. So brand, to answer your question, and confidence is massively important. And particularly in the crypto industry, where blockchain makes it very easy to withdraw funds, that's the whole point. Transactions happen very fast and very efficiently. Confidence is supremely important. And that's why we found that cover creators like our parametric approach. So just very briefly, one of the difficulties with insuring individual assets is that when it comes to paying out on the loss of an individual asset, then you have to assess that loss. So imagine you have an exchange with 100,000 users and they all suffer a loss. That immediately means that you have to evaluate 100,000 different individual claims for losses. Now, Neptune Mutual uses a parametric approach where we actually, all we need to do is to assess the incident itself and not an individual's loss. Whether someone actually has made a loss is irrelevant to us. It's just the incident that happens. So in some respects, you could say the parametric cover is more like a hedging product. So that means that the instant resolution process is scalable, because each time that there is an incident, we have one instant to assess, not 1,000 or 100,000 or 1,000,000 individual loss claims. And because of that, we can resolve that instant within 7 days, and there is a 24-hour cool down period. So claims can be made within 8 days of an instant. Why does that matter, and why am I referring to this in relation to your question? It's because when there is a technical problem, some kind of hack or a liquidity issue or something's gone wrong in blockchain, that project needs to sort the problem out really quickly to protect their brand, to give the confidence back to their communities and resolve the problem really fast. And that's what parametric enables you to do in a way which it's far more difficult to do with a sort of discretionary approach. Now, discretionary protocols do work and they do solve problems, but the bigger the problem and the more people that are affected, the more challenging it is for them to solve the problem quickly. And again, with brand, getting confidence back after you've had a problem is massively important. And so hopefully that's something that our new and different approach can help with.
It's parametric is something we've discussed a lot on the podcast, and I've been a big proponent of it. I just just by virtue of my nature, I'd prefer less admin and more instant payment for everything I can get to. And then also as a small business owner, it particularly resonates with me in that I'm not going to go under through anything other than potentially lack of cash flow. If that was my kind of situation, waiting for a payout and it puts you under, is the irony of it. But I was thinking about the role that you're playing is that parametrics usually, I think, for insurers is a brilliant way to create value in the brand of the insurer and say you've had a good insurance experience, and it allows you to wow a customer. And we talk about wowing customers in the modern era all the time, but you're doing something even more challenging than that. It's keeping confidence in a sort of, could be a fledgling currency, as it were. So there's even more reason to kind of put in these things that are innately transparent. If X happens, then Y will be delivered to you, and in a short period of time. So I can see how powerful that be. Something you touched on was liquidity, this might be a more obvious question, but how does the design of Neptune Mutual help tackle those liquidity issues? Because I know that's something that it addresses.
Yes, so I guess there's there's various answers to that. So we've talked a little bit about the liquidity issues that cover projects can face, and so custody risk can be something that is covered by the cover pools. So a cover creator can create a policy that protects their community against that. That's the first thing. But I think your question was more around, if I understand correctly, more around how do we design a cover protocol that lends itself, perhaps that's not quite the right use of the word, but that is designed in such a way as to attract liquidity providers. Because where you have a whole category, and I would say an important one like DeFi insurance, with only $300 million worth of total value locked in relation to $50 billion worth of assets, clearly there's an issue with the scalability of the provision of liquidity into that category. Yeah. And so that's what we've looked at fairly carefully. And as I said before, being a marketplace, there are the users of the ecosystem can put liquidity in. And I think so. Some of the factors that are important to consider. Perhaps first and foremost, I think you need to think when designing a system on behalf of the person you're designing it for, so a liquidity provider. And one of the things that you really need to be careful of before investing capital in a project is, can I get it out? And DeFi insurance is one of those spaces where, because you're using the capital to underwrite risks for a period of time, it's easy if you're not careful to end up with a situation where you put capital into a DeFi insurance protocol. That capital is used to underwrite risks, and then you can't get it out because it's being locked up and used to underwrite risks. And not only that, but the more the cover protocol is successful in writing more and more risks, then the less possibilities there are for you to get your capital out. So we've designed in a system where there is a window of 7 days every 180 days where LPs can get their capital out. So I think that's really important. And probably, one of the other things I would say is, where you're providing underwriting capital, it needs to be really transparent where the returns are coming from. Because, your listeners in particular will know that the returns that you get from providing underwriting capital should be directly linked to and correlated to the amount of risk that they're underwriting. That makes entire sense. Now, in our case, we have cover pools that are denominated in stablecoin, both for the cover purchaser who buys their policies, and those fees are being used to pay the users who are providing the underwriting capital. So there's no mismatch in the type of capital that's being used to reward the underwriting capital providers. But that's not always the case. And many protocols actually reward underwriting or the providers of liquidity, LPs as we call them, with tokens, project tokens. And so you then have to look quite carefully at the returns that are being given, because those tokens, or the price of those tokens, are probably being influenced by the crypto market. So, if the price of Ethereum is going up and the price of tokens are going up, then the returns that liquidity providers will be going up. And the converse is obviously the case. So if the market movements in crypto pricing are big, then that will significantly influence the returns that an LP is getting, far more than the returns that are actually coming from the policy fees. And therefore, it becomes unclear as to how it is that you're making or losing money as an LP. And if it is simply that you're making money because the price of Ethereum, for example, is going up, well, maybe you're just better buying Ethereum full stop, rather than getting a return from the price of Ethereum, but nonetheless suffering the consequences of the risks of providing underwriting capital and that specific risk. So we've in our cover pools, removed price volatility from the equation. So it makes it very much more transparent where returns are coming from, which are the policy fees of those that are purchasing covers in stablecoin. So those are just some of the things which hopefully will attract LPs to the site. They can understand the model, they can understand the system, where the returns are coming from, and they can get their capital out.
Yeah, I think getting the capital out, is a really nice, timely thing to be talking about, should we say? Something I'm surprised to learn, and I suppose this kind of resonated with me from the sort of 2008, 2009 times. But I don't want to draw that negative connotation. But so I can buy this insurance without what we would traditionally think an insurable interest. Like I don't have to have active investment in this project to buy insurance on that. I suppose one was just to explain that, and that I'm correct on that. But if that is my understanding is correct, does that not potentially put us at risk of bad actors further down the line?
Well, I would say that most businesses and pretty much everything is exposed to bad actors of one form or another. So, so yes, we are exposed, as everyone else is, to bad actors, but I don't think specifically that relates to the sort of parametric approach. So it's true to say that you don't need to suffer an individual loss. You don't have to have an asset loss. You don't have to hold an asset at all, in fact, to buy parametric cover. But that is no different from hedging products. And there's, I don't know, there's $130 billion worth of options out in the market at the moment. I don't know if that's a good analogy or not, but certainly traditional insurance parametric cover doesn't require individual loss assessment. And to be honest, that's one of its advantages. It makes hedging risk that is very difficult to assess from an individual loss point of view. It makes it feasible in a really efficient way, and that's one of its sort of values, if I can put it like that. But you're right, we do have to be very careful, and there are some scenarios which we have and need to protect against to make sure that if bad actors are the ones that are creating the risk incident, that they can't benefit both from creating the incident itself and then profiting a second time round from the cover that they could potentially buy from our marketplace. And so we do have systems in place to do our best to protect against that.
Yeah, absolutely. I think that's absolutely nailed on answer my question. Edward, I could talk about this for a very long time, because I think it's a fascinating area, and it's really nice to have someone come on and talk about a real sort of net new space for us as well. So firstly, wanted to thank you for being a guest on the podcast, but always like to end with we're coming to the end of Q1, but we've got plenty of the year to go. So, and you raised, relatively recently, what's on the agenda for this year? What can we expect to see further from Neptune Mutual for the rest of this 2023?
So there's exciting times ahead. So we launched on Ethereum, the Ethereum blockchain, layer 1 blockchain, in November. In January, we launched on Arbitrum, which some of your listeners may know is a layer 2 scaling solution, which it's really fast with low transaction fees. And we're now the one DeFi insurance cover protocol on Arbitrum. We are looking to launch on other layer 2 scaling solutions as well. So that's something to keep an eye out for. We are also launching soon our token, our NPM token. So that's exciting and will be happening in a matter of weeks. And that's really important for us because it will tie in our community into actively engaging in a number of new and different ways with the platform itself. So the NPM token is really important for us. And we also have an NFT project. So again, people will be familiar with NFTs. And in our particular case, we are very much tying it to use of our marketplace. So those users in our community that use our marketplace will gain points, and those points will allow them to unlock some NFTs, and we just hope that's an interesting and fun and valuable way for the community that are using our marketplace to find some extra value. So that's going to be launching fairly soon too.
Wow, it's a busy year coming up. So Edward, I really appreciate you finding the time. Like I say, genuinely insightful and interesting conversation. Really appreciate you being the guest on the Leadership in Insurance podcast.
Yeah, it was my pleasure. Thanks very much for having me, Alex.
Thank you.